Hi, thanks for tuning in. This is a technical analysis video on intermarket analysis, the concepts that were first introduced by John Murphy in his book, Intermarket Technical Analysis from 1991. What you're looking at on the screen here are the screenshots that I took from the CMT Level 2 textbook. I have found this material to be very, very helpful in determining macro trends. And when you can see these major pivots in things like the dollar, in things like interest rates, what the long-term impact implications are, and how that affects asset allocation. And so at the high level, you have to talk about what hard assets and soft assets are. Hard assets are commodities, gold and silver, wood, lumber, corn, etc. And soft assets are financial assets like stocks and bonds. And there's an inverse relationship between the value of hard assets and soft assets. And that correlation exists because there's a positive relationship between material prices like gold and silver and interest rates. So inflation or higher material prices is associated with higher interest rates. And when inflation becomes a threat, paper assets decrease in value as interest rates rise and become undesirable investments. And likewise, when hard asset prices decline, like gold and silver decline, rates usually declined and soft assets increase in value. The theory that one or the other of these kind of assets becomes popular for substantial periods of time is not a new one. Now, this isn't always the case. Between 1998 and 2012, the relationship did not hold. Gold, which was traditionally the measure of hard asset prices, was not outperforming. And yeah, what I want to look at here is how we can use this information when we look at secular and cyclical trends. Okay? Secular is a term used for any period longer than the business cycle, which is about 4 to 5 years. So one could state that we're still in a secular bull market going back to 2009, for example. What we will do is look at the relationship here. So what does this mean for investment selections? Being in the time period following 2012, the signal for the switch to soft assets suggests that the analyst should be concentrated on those investments concerned with stock market or bond market. And why? Well, because in 2012, ratio of gold to stocks topped. Okay? And this became a signal in which you could use to concentrate your portfolio in soft assets like bonds and S&P 500 and no longer in assets like gold and silver. You can see the same thing happen with industrial metals. Okay, and you can see, this chart is clear as day. When you have this signal where this top was given in the ratio of gold to stocks right here, where you lost this moving average, which was the 24-month simple moving average. When that was lost, you then lost the long-term uptrend in gold and the outperformance of gold relative to the S&P 500. Okay, so that's just one way that you can use these, right? Let's take a look at bonds to the S&P 500. Let's take a look at, gold to the S&P 500. And remember, there's only 3 assets really that we could be looking at here. Gold and commodities, bonds and stocks, or real estate. And so you can constantly do the pair chart like you've done here and identify where your investment allocation makes the most sense. Okay, so let's keep moving on. There's just a few more concepts here. The cyclical emphasis. So within the long-term secular trend, there are a number of business cycles that exist. These cycles are varying in length, but usually average 4 to 5 years. And they are the normal horizon that most economists and managers, investors think about and live in. Martin Pring classifies investment markets into 3 categories: commodities, bonds, and stocks. Murphy adds currencies and to some extent foreign stock markets to the list, but the business cycle affects each of these markets in different ways. Here's one that's very, very popular. The US dollar and gold. That Murphy maintains that currency rates influence industrial prices, but sometimes with a considerable lead. The dollar is important in that it is pricing currency for many of the world's raw materials, such as oil, gold, and other precious metals. When the dollar declines, it makes these commodities cheap in foreign currencies, but expensive in dollar terms. Thus, there is a leading inverse relationship between the US dollar and raw material prices in the United States. So then they go on to show you in figure 4, right, what happens to Dixie when Dixie tops, gold's bottom. And then the ratio of the US dollar to gold also topped. And you can use that pair chart again, those ratios, to help you determine. So here's what we have right now. This is using real world examples. So you can pull up the chart of gold and the chart of Dixie, and you can see that here back in 2022, October 9/28, you have a top in gold. And you had, a top in the Dixie, the dollar. And gold itself put in a bottom. Then as price started to rally, you notice that there was basically a lower high each time. And after the third lower high, and notice here, they do break the low in gold. That's a trick. They love to go down and break the low. They know where your stops are. Just remember that. They go down and broke that low, even though the dollar did not. And then this high here, right, which was the lower high. This was the higher low on dollar. At the exact same time, the trend changed for gold, and the uptrend was lost for Dixie. And you can look at gold rallied ever since. And gold now put in a short-term top as the dollar was putting in that bullish divergence short-term bottom. Okay? You can see that these two are negatively correlated. Dixie goes down, gold goes up. Okay? And this relationship was shared with me during my studies of the CMT Level 2, but is talked about by Martin Pring, talked about by John Murphy in their books on intermarket analysis. So US dollar and gold is a very, very important one. And many use gold as a proxy for the industrial prices because gold is well defined. And you can use a trend line like I had here, right? This trend line break, this horizontal, this lower high. You can use the trend line to help identify a shift in where your asset allocation should be located. And if you include intermarket analysis in your swing trading, you can see how easy it becomes to try to allocate based on these relationships. Instead of guessing, you just wait for one to clearly outperform the other, and then you shift your allocations accordingly. There's the bond market and the stock market. There's a relationship there. Ideally, the normal business cycle sequence, the next switch in markets is from the bond market to the stock market. Murphy argues that this is because for the first time since 1930s, actual deflation has become a threat and has upset the previous balance between interest rates and the stock market. Nevertheless, a plot of the ratio of bonds and stocks shown in figure 6. So the long-term interest rates goes down. Ratio of interest rate to stocks right? After 2003, the stock market bust, stocks outperforms bond handily. However, in 2007, almost at the peak of the stock market, the ratio turned up, suggesting that stocks be sold in favor of bonds. And again, at the bottom of the market crash, the ratio swung the other way, suggesting a return to the stock market again. This suggests that the bond to stock ratio has an excellent history of timing the stock market. So if we take a look at stockcharts.com, we can take a look at the SPY to TLT ratio. And as you can see, even though markets had a correction in 2022, you still favored equities over bonds. Now, SPY relative to gold is consolidating, and basically is consolidated since the top. Pulled back and then it's gone sideways. This is a huge trading range. And if you look at SPY relative to the dollar, right, you could see that the dollar was the only asset class that outperformed SPY in 2022 of the three defensive assets. One being gold, one being bonds, and the other being cash. And so I just want to point out that this is how I use intermarket analysis and a macro view to tie into the technical analysis that I'm doing. Okay. And the final piece here is the US dollar and the stock market. The dollar usually leads industrial raw material market, gold, all the hard assets, all the raw materials, which in turn generally leads the bond market, which in turn leads the stock market. And by connecting the loop, nothing is accomplished because there seems to be only a slight relationship between the stock market and the dollar. This also may have changed because figure 7 shows that the dollar now has an excellent timing relationship with the stock market. And I would agree. Right now, in today's market, if the dollar goes up, the stock market has a hard time rallying. The dollar to stock ratio gave a buy signal for the dollar, and that's the one I just showed you over here. This is the dollar to stock. So right now, we just got a buy signal here for equities. Okay, at the start of 2023, you got the buy signal for equities over cash. And at the beginning of 2022, you got the sell signal. And as you can see here, the dollar tends to have an inverse relationship with the stock market. At least it did at the top. So these are the things that I just like to point out. I don't want this video to get too long. It is very, very basic in its concept. And so the idea remains the same. These intermarket relationships will act as driving forces for the asset classes the majority of the time. And it's very important to note these are not absolutes, and that these relationships can change. And it's important to notice when they change and try to make sure you are aware of what market you're in and if it makes sense from an intermarket analysis standpoint. And to swing trade and allocate based on the intermarket analysis concepts that were laid out by John Murphy in 1991. And if you like this video, hit the like button, subscribe, and I'll see you next time.